Hello there! In part 4 of lecture series 2, I will focus on qualitative characteristics of useful financial information. The qualitative characteristics of useful financial information is set out in chapter 2 of the conceptual framework, breaking it into two broad headings of fundamental characteristics and enhancing characteristics. Included under fundamental characteristics are relevance, and the other is faithful representation. Question: how do we determine if information is relevant? Information is relevant if it's capable of making a difference in the decisions made by users. Thus, for information to be relevant, it should have either predictive value, confirmatory value, or both. Information has predictive value if it can be used as an input to processes used to predict future outcomes. Information has confirmatory value if it provides feedback of previous predictions. In assessing if information is relevant, we should consider the materiality of the items. Please be reminded materiality is entity-specific, meaning it's based on nature or magnitude or both of the items to which the information relates in the context of an individual entity's financial report. Items are considered material if its omission or misstatement influences the decision of users. Additionally, information should faithfully represent the transaction, meaning it should reflect the economic reality of the transaction rather than merely the legal form. Moreover, faithful representation seeks to maximize the underlying characteristics of completeness, neutrality, and free from error. In ensuring a neutral depiction, it is necessary to exercise prudence, meaning caution when making judgments under conditions of uncertainty. The framework includes comparability, verifiability, timeliness, and understandability as qualitative characteristics to enhance the usefulness of information that is relevant and faithfully represented. Let's look at each of these characteristics separately, starting with comparability. The usefulness of information is enhanced if it can be compared with similar information about other entities and with similar information about the same entity for another period. To ensure comparability, the accounting treatment should be consistently applied from one accounting period to the next. Verifiability means that different, knowledgeable, and independent observers could reach consensus, although not necessarily in complete agreement, that a particular depiction is a faithful representation. Thirdly, information should be provided on a timely basis for it to be capable of influencing the decision-making of users. Finally, information should be presented in a clear and concise manner for it to be understandable. We must bear in mind some phenomena are inherently complex, but excluding such information would make financial reports incomplete and potentially misleading. It's important to note that financial reports are prepared for users who have a reasonable knowledge of the business, its economic activities, and who review and analyze this information with diligence. In my next part of the lecture series, I will look at recognition and due recognition of assets and liabilities, chapter 5 of the conceptual framework. Till then, thank you and have a nice day.